Hello and welcome to Follow the Money. I'm Gerg Cahiles. Join us as we explore the tools and insights you need to jumpstart your financial journey. Trade tensions between the U.S. and China remain high. There have been mixed reactions as to whether the tariff threats of U.S. President Donald Trump will have an adverse effect on the Philippine economy. Some see it as an opportunity for the Philippine government to push for a trade agreement with the U.S. Others warn the tariffs could trigger an economic slowdown in the U.S. and deal a blow to Philippine exporters. To get a clearer picture on this, we'll talk to Diwa Gunigundo. He's a former Deputy Governor of the Bangko Sentral ng Pilipinas. Good afternoon, sir, and thank you for joining us this afternoon. I think your mic is off, sir.
Yeah, thank you very much for having me here.
Thank you very much, sir. Well, let's start off with your reaction to Trade Secretary Cristina Roque's statement that the Philippines is considering importing more agricultural products from the U.S. as it seeks to negotiate a lower tariff rate this week. So how might this affect the Philippines' trade balance and inflation outlook?
Well, that plan to import more agricultural products from the U.S. appears to be some kind of an appeasement. Mm-hmm. In 2024, for example, I'll tell you why, we enjoyed a trade surplus with the U.S. of around $5 billion, having exported to the U.S. some $14.2 billion and imported from the same country around $9.3 billion. If it is indeed necessary to do so out of actual demand and price considerations, why not? However, we should also bear in mind that our overall trade deficit continues to bloat year after year. And last year, it stood at some $68.7 billion. Thanks to our export of services, bringing in cash remittances and BPO revenues, the overall current account deficit has been reduced to some $17.5 billion. There's nothing to appease the U.S. about such a trade shortfall. It is a product of market competition. Now, if we decide to import more, and if it's not for productive uses, that will tend to worsen our trade shortfall. A better approach, I would say, would be for our economic managers to negotiate first with their U.S. counterparts the possible reduction from 17% in reciprocal tariff, and if absolutely necessary, commit to consider ways to mitigate the trade balance without compromising future decisions of our business community and the spending patterns of our consumers. If the U.S. refuses to compromise, then we already preempted the possible outcome of our trade position. In the first place, the formulation of those reciprocal tariffs does not lend itself to either reason or logic.
Mm-hmm. And currently, sir, how should the BSP respond if increased U.S. agricultural imports lead to greater pressure on local producers? Because if you import more, it might have an impact to our local agricultural sector. So how will it happen, or what should the BSP do?
Yeah, that's right. However, agricultural imports from the U.S. represents a very small amount. Mm-hmm. About 15% of the total value of overall agricultural imports, or only about $1.7 billion out of more than $11 billion that we import in terms of agricultural products. In other words, even if that DTI plan is carried out, the impact on overall external payments position is rather small. Therefore, the BSP does not have to do anything but continue to allow the peso to remain flexible and adjust accordingly.
Mm-hmm. Earlier, sir, you said that importing more is more of an appeasement. And of course, you said it could also trigger a possible non-productive impact to our economy if it's useless. Okay, if we're not of use of any of those agricultural products. So, and you said also from 17%, what do you think is the fair tariffs that the U.S. should impose to the Philippines, sir?
Well, I'm not sure about the fair level or rate of reciprocal tariff. In the ASEAN, the lowest is actually 10% for Singapore. Actually, we have the second,
Lowest.
lowest, no? The
Yes,
lowest.
right.
And therefore, in the case of the Philippines, if we are imposed a 17% reciprocal tariff, that is second lowest in the region. And therefore, for me, the important challenge for our manufacturers and other types of exporters in the U.S. is really to improve on their cost, improve the quality of their products that they export to the U.S. So even if they're slapped a 17% import tariff, they will remain competitive.
All right. So, do you believe, sir, that a free trade agreement with the U.S. is realistic in the near term? And what monetary or macroeconomic risk should we watch out for in pursuing one?
Well, yeah, FTAs or free trade agreements are not necessarily violative of the World Trade Organization rules because they can be construed as preparatory to a broader trade liberalization. It would just be strange to see many of the countries in the region hard hit by the stiff reciprocal tariffs negotiating every one of them with the U.S. bilaterally. It would also be equally strange for the Philippines with the second lowest reciprocal tariff or any one of the ASEAN trading partners to be looking after its own in external trade. Indeed, what President Trump did was to destroy the institutional open global trading system. In negotiating for an FTA, it should be clear to our trade team that they should stress in at least three principles. Transparency, in other words, the subject of FTA should be fully disclosed. Second is reciprocity. It should not be a one-way agreement. And thirdly, reasonable coverage. Not all of our products should be subject of FTA. Now, to the extent that trade with the U.S., which will be the subject of an FTA, is reasonably manageable relative to overall trade and with other countries, we don't think there are monetary or macroeconomic risks in the near term that should worry us.
I'm just wondering po, do you think that this tariff strategy of the Trump administration is going to be a long-term policy of his government, or he's just being a businessman, trying to, get something, or trying to be transactional in a sense?
Well, I think all of the above. All of the above because, one, there is no basis for predicting what President Trump will do next. Second, so far, in the first few months of his presidency, everything is unpredictable. Everything seems to be not lending itself to some reason or some logic. So it's very difficult to predict. But what I can say is that this is going to destroy the US's economy itself. The reciprocal tariff will make commodity prices in the U.S. very prohibitive. It will impoverish many Americans because their purchasing power will be affected in the process. Now, if the political and social unrest becomes more intense, I'm sure the U.S. Administration will have to shape up or, face more serious, difficult challenges, both from their own lawmakers and their own people.
Sir,
What they're doing could be very destructive over the long run.
If you're saying, sir, that it will destroy the U.S. economy, definitely it will affect, in a way, those Filipinos who are staying in the United States, and it will potentially might affect the remittances from the U.S. So, what's your opinion on that, sir?
That's possible, no? Because basically the policy of Trump focuses on one, higher tariffs, two, tax cuts, especially for the corporates, And third, stamping out illegal immigration, according to them. Now, the basic fundamental problem of the U.S. actually is overspending. Overspending on their military, overspending on intelligence, overspending on wars that they fight in various fronts. And yet, because of this overspending, the U.S. is also borrowing left and right. And therefore, the additional burden on the fiscal sector comes in the form of very prohibitive debt amortization costs. And that will actually affect the sustainability of the fiscal sector. So the idea is that higher tariff rates is not the solution, but it is the solution is to shape up the fiscal sector of the United States economy and start strengthening their manufacturing base and become more competitive with the rest of the world.
And you're saying now, sir, that they
Sure.
should...
Yeah, sure. That many of our Filipino compatriots will be affected. And in fact, that will also affect the possibility of having a lower remittances coming from the U.S. But this is something that perhaps can be worked out when the U.S. economy starts feeling the pinch of these policies of the president.
Yeah, you're saying to fix their own backyard first, no? But from the United States, sir, let's go to the United Kingdom because the Philippines and the UK are expected to sign an export finance agreement within 3 months involving an allocation for the Philippines of about 5 billion pounds or 375 billion pesos. So how do you see this impacting the Philippines' infrastructure development and economic growth in terms of the medium and long term?
Well, the option being offered by the UK is through this export finance agreement. Under this agreement, based on what is available in the media, the UK's export finance will support British firms' participation in infra projects like bridges, railroads, offshore wind farms, and even ports, whether seaports or airports. That could be game-changing, say the least. Now, if this materializes, the Philippine imports from the UK can be financed by bank loan guarantees or different forms of support, as long as a minimum of 20% British consent is complied with. Now, UK is very strong in infrastructure, financial services, and even digital technology. In effect, this approach could in fact provide more meaningful support to the cause of advancing accelerated and sustainable economic growth in the Philippines. These projects aim to strengthen our infrastructure and manufacturing backbone rather than simply import or export products. So to me, it's a good option being offered by the UK.
We will discuss more about that, sir, but we have to pause for a few reminders. Stay on BNC and follow the money. Welcome back to Follow the Money. We continue our discussion with former BSP Deputy Governor Liwa Gunigunda. Sir, earlier you were talking about the benefits of this export finance agreement with the United Kingdom. But are you seeing any possible cost to the Philippines when we enter into this?
Well, I'm not sure because right now, the government has really embarked on in various fronts on how to provide not only public-private partnership in undertaking various infrastructure projects. We also tap international financial institutions, development banks like ADB and World Bank, precisely to provide additional support to the budget in implementing all of these infrastructure projects. So I think this is one option that perhaps worth exploring.
Okay. Now, regarding U.S. tariffs, UK Ambassador Lori Boffel said the Philippines will have some difficulty attracting companies seeking to relocate from high tariff countries due to the high cost of energy, and the country doesn't really have a manufacturing base that's ready right now. So, do you agree with her, sir?
Yeah, I perfectly agree with the UK ambassador because high cost of energy and the fact that our manufacturing base isn't ready yet, they are both structural in nature. And it would be a tall order addressing such structural issues. On top of that, connectivity in the Philippines, both physical and communication, is very limited. Human capital development is very weak because public education and public health are in bad shape. We need to strengthen IT and innovation and increase its use in all of our economic sectors to increase productivity as well as economic efficiency. So there will be some difficulty in the short run precisely to attract all of these foreign investors.
Okay, so what should the government do regarding this, sir? I mean, you said, you mentioned about the concepts, what must be done, but what are the specific actions that must be taken?
Well, it will be difficult to do that immediately. As I
Yes.
said, in the short term, it will be difficult. It will be a tall order to do that. Many of our problems are structural. But in the short term, the government can aim for lowering the cost of doing business in the Philippines, like reducing energy cost, better matching of supply of and demand for labor, and also various skill sets. The Philippine government can also embark on streamlining the bureaucracy to avoid many layers of getting permits, for example, to operate and avoid corruption at various levels of governance. Make sure we have the rule of law. That is, investors should get that strong signal that we respect property rights and private contracts. I think if the government can focus on those few game-changing reforms in the short run, I think we can have a share of those foreign investors from high tariff countries.
But the government, sir, has been boasting about their actions regarding streamlining and ease of doing business in the Philippines. Are you not satisfied yet? I mean, are you thinking that the government can do more?
Oh, yes. If you take a look at various indicators, ease of doing business, we have a long way to go. Perception of corruption or corruption perception index, it's improving somewhat, but the pace is glacial. In other words, we are still low relative to the other countries in the region. Okay? In terms of innovation, we are doing quite well. In the case of addressing political stability, governance effectiveness, and regulatory quality, I think we have yet to do a lot more because our score from a range of minus 2.5, negative 2.5, to a high of positive 2.5, in terms of political stability, we're still in the negative territory. And in the case of governance effectiveness and regulatory quality, we're just about zero. See? So we have a long way to go.
All right. So now let's talk about your inflation outlook for April. And can you discuss it to us? Why?
Well, our inflation forecast, we are also principal advisor of global source, partners in the Philippines. Our inflation forecast for April is about 2 to 2.5%, a little higher than March. And we have seen a relatively strong peso recently, despite the tariff war. The peso is gaining some grounds relative to the dollar. Prices of food commodities have somewhat eased because of liberal trade policy and lower tariffs. And a possible influx of these cheap imports from those affected by higher reciprocal tariff in the U.S., which means China. And now this could influence lower prices and therefore lower inflation. The only upside risk that I can see is the possible transport fare adjustment, which is based on schedule. So our inflation forecast is about 2 to 2.5% for those reasons.
All right. Now, how many rate cuts do you think the central bank will do this year, and why? And about the basis points, sir, will the BSP cut this year, and why?
Well, while the BSP has sounded more dovish recently, I believe it would also remain cautious about taking a more aggressive monetary policy stance. There's a lot of uncertainty in the air, and the BSP, I believe, recognizes that. And if their lower risk-adjusted inflation forecast this year, and they have been lowered relative to their previous meetings, the next will carry over the rest of the year. In other words, this inflation forecast, this lower inflation forecast this year, will also extend up to 2026. Then we might be looking at a couple more interest rate cuts. Now, I still believe that BSP will remain cautious, that even if it has the flexibility, because inflation forecasts are very benign, and actual inflation turnouts are also within the 2 to 4% inflation target. It would also do that in baby steps of about 25 basis points. That means all in 75 basis points for the year, including the 25 basis points that it did early in April. Okay? Now, that means if the risk-adjusted inflation forecast of 3.3% next year holds, bringing the policy rate to 5%, right now it's 5.5 after the 25 basis points cut early this month. So we're still looking at possibly 50 basis points more. In other words, 2 more interest rate cuts of 25 basis points. So we expect the 5.5 to be reduced to around 5%. To me, that is just about right. 50 basis points subtracted from the current 5.5 gives us 5, and that policy rate allows the rate to be positive in real terms, with enough risk premium for global and domestic risks and uncertainty, while maintaining some positive differential with the U.S. federal funds rate. I have to emphasize the need for maintaining this interest rate differential, because in the past, even while I was still at the BSP, when we see the interest rate differential narrowing, okay, we see some episodes of capital outflows and therefore weakening of the Philippine peso. Now, I'm sure the BSP is very cognizant of that because of the exchange rate pass-through. If capital outflows ensues and we have a weakening of the peso, there's also a chance that inflation will also be disanchored in the process.
All right. The BSP has all the reasons to be cautious. Well, thank you so much, Sir Diwa Gunigundo, a former Deputy Governor of the Bangko Sentral ng Pilipinas, for your time.
Thank you very much, too.
Before we go, here's a thought from John C. Maxwell. Dreams don't work unless you do. And that's it for today's edition of Follow the Money. I'm Gerg Cahiles. Thanks for watching and keep it here on the BNC, the Bilyonaryo News Channel, always on top.